All right, we are going to start the first chapter of the Audit and Assurance, and the first chapter is Introduction to the Audit. Now, before looking at the definition of the audit, you need to understand the background of the audit. What is the background of the audit? Like, what was the reason of the audit being started? So, the background of the audit is agency theory. Like, you need to understand this agency theory. Probably you have studied this thing in your F1 or the FBT exam and also the F4 exam. But if you don't remember, then there is no issue. I'll explain it to you from the scratch. Agency theory means the relationship between the principal, the relationship between the principal and the agent. Agency is the relationship between the principal and the agent. And in the context of the companies, the shareholders are the principal and directors are the agent. And why the principal hires the agent? Principal hires the agent to work on his or her behalf. And in the context of the company, shareholders hires the directors to run the company. And we know the concept that in the public interest entities, the public limited companies, the shareholders are not running the company. They are sitting outside the organization. They have the ownership, but they have given the control to the director. So in F4, the law paper, we studied one thing, that is the separation of ownership from the control. The shareholders are sitting outside the organization and the directors are running the company. In the public interest entities, there is a structure that the directors are running the company. Like when you talk about the private limited company, mostly the shareholders are the directors as well. But we are not talking about the private limited companies. We are talking about the public interest entities, the public limited companies. The element of succession over there, that the shareholders will change, the shareholders may change, but there will be no legal problem with the company. The company will continue to grow. The company will continue their business. Even the shareholders are changing. This is what we call the succession. That the shareholders may change. You can buy the shares on the stock market. Like for example, in the morning, I'm having the shares. In the evening, I may sell the shares and you may buy it. The shareholders may change, but the company will continue its business. There will be no change on the legal structure of the company with the change of the shareholders. This is what we have studied in the law paper. So the background of the audit is the agency theory. It is the principal and the agent, the relationship between the principal and the agent. The shareholders are the principal and directors are the agent. Now, how this concept is connected with the audit? The directors have the duty to run the company in the best interest of the shareholders. This is their fiduciary duty of trust to run the company in the best interest of the shareholders. But when they see a lot of money coming into the company, they may get diverted. They may start filling their own pockets. They may start acting in their own interest. And this concept is known as the agency problem. Ideally, the directors should run the company in the best interest of the shareholders. But there can be an agency problems where the agent, and in the context of the company, the directors may act or may start acting in their own interest. Like you probably have heard regarding the corporate scandals in your F1 paper, like Enron, like South Seas, like .com, Lehman Brothers. There are a lot of corporate scandals you probably have studied in your corporate governance chapter in your F1. The problem over there was that the directors were having too much power. Shareholders were sitting outside the organization. The directors were investing in the many risky projects just to get their own significant bonuses. And at the end, when they were losing the money, they were depicting a wrong picture of the company to the shareholders. Now, how the shareholders would know how well the company is performing? Obviously, the directors will be and the management will be preparing the financial statements, and those financial statements will be presented to the shareholders. Ideally, the shareholders should believe on the financials prepared by the directors. Ideally, this should be the case. Ideally, the shareholders should trust the directors and they should rely on the financial statements being prepared by the directors, but this is not the case mostly. The shareholders lack trust over the directors. That is why they need an independent person. Now, when we say independent, that means the shareholder, the auditor should not have any sort of relationship other than professional relationship with the company. Like there should be no personal relationship, no family relationship. An independent person who is independent of the company, who is independent of the directors, who come and check the financial statements prepared by the directors and then tell the shareholders whether those financial statements shows the real picture of the company. So this is the background of the audit. The background of the audit is the agency theory and the agency problem attached to it. That shareholders are sitting outside the organization. They have given the complete control to the directors. Directors have all the money. They are managing the money. They are running the company. They are preparing the financial statements. So there is a risk that they may show the incorrect picture to the shareholders. They may manipulate the financial statements. They may do the window dressing. They may have done the creative accounting. All of these terms are gives the same meaning, like window dressing, manipulation, creative accounting. So that is why the shareholders need an independent person who is independent of the company, who is independent of the directors, who come and checks the financial statements prepared by the directors and then gives the confidence to the shareholders regarding the financial statements that whether these financial statements shows a real picture of the company. And that real picture is known as the true and fair, whether the financial statements are true and fair. So when an independent person is giving the confidence to the shareholders, they will obviously rely on their statement. They will obviously rely on their opinion. So audit is an activity. Remember this thing that audit is an activity. Audit is an activity in which the auditor, are checking the financial statements, evaluating it, and then giving confidence to the shareholders. Assurance simply means the confidence we are giving to the shareholders in the form of our opinion. So assurance is the product of this activity. Like audit is an activity and assurance is the product of it. Once we check the financial statement, then we give the assurance to the shareholders. Now, the plain definition of the audit is that audit is an independent examination. Audit is an independent examination, an expression of opinion on the financial statements of an enterprise. Now, there are a few things you need to understand. The independent thing is that the auditor should not have any sort of relationship other than professional relationship with the directors in the company. For example, if the auditor is too familiar with the directors, for example, they're having any personal relationship, any family relationship, any long-standing relationship, they will not deemed to be independent. Examination means the evaluation of the financial statements, the checking, the inspection. And then once they are done with the examination, once they are done with the evaluation, they will be expressing their opinion. The expressing the opinion, the expression of opinion means whether the financial statements gives a true and fair view. And when you talk about the true means that the information presented in the financial statements is factual and confirms with reality. Like for example, the revenue figure presented in the statement of profit or loss is the actual turnover, is the actual sales the entity has made. It's not being manipulated. The assets they have presented in the statement of financial position actually exists. So true means the information presented in the financial statement is factual and it confirms with the reality. And fair means that information is unbiased and impartial and depicts the commercial substance. And like you have studied the economic reality concept that in accounting, we always look for the economic realities rather than legal forms. Now, can the information be biased? Yes, information can be biased. Like, let's say I am the director of a company, and let's say I'm the finance director, and I'm in charge of preparing the financial statements. My bonus is dependent on the year end profit. Now, when my bonus is dependent on the year end profit, I may try to manipulate the financial statements. I may try to window dress it. Now, if there's something coming to your mind that are there any ways of manipulating the financial statements? Yes, there are thousands of ways. Let me give you a simple example, which is completely understandable. For example, I have purchased an asset. Let's assume I have purchased an asset and the cost is 100,000. Cost is $100,000. And the useful life is 10 years. The depreciation charge should be 10,000 per annum. Now, this is the expense that you will be recording in the financial statements. 10,000 per annum. What if I take 100,000 divide by 15? I extend the useful life by 5 years. Now, what should be the depreciation charge? Obviously, now the depreciation charge will decrease. Now the depreciation charge will decrease, like 100 divide by 15. It is 6.6. I should have charged the expense of 10,000 in the statement of profit and loss. Instead, I am charging the expense of 6,600. This is the manipulation in order to boost the profits. For the receivables, you should record the allowance for receivables. If the directors are not recording it, that means they are manipulating the profits. The research cost should be expensed out, but what if they capitalize it? They are understating the expenses and they are overstating the profits. So there are a lot of ways. You already know that you're an accounting student. You already know that the manipulation can be done by not recording the expenses, by overstating the income, by understating the expenses, by overstating the assets, by understating the liabilities. There are a lot of ways to manipulate the financial statements. That is why the auditor is there. He will be looking at the financial statement, whether it is true and fair. True means the information presented in the financial statement is true, factual, conforms with the reality, and fair means it should be unbiased, it should be impartial. There is a possibility that the directors are manipulating it in order to get more bonuses. The auditor needs to be skeptical regarding that. So that is why we, being an auditor, we are there. That is why the shareholders need us to check the financial statement and gives them the confidence regarding the financial statements. So audit is an independent examination, an expression of opinion on the financial statements of an enterprise. And we know the financial statements means the statement which shows the financial performance and position of the company. And we talk about the enterprise, like which company will be having the audit. And we know it from our law paper that the listed entities are required to have the statutory audit, the compulsory audit. They do not have any choice of it. But the private limited companies, obviously, if they meet the certain benchmark which is defined within the company law, then again their audit is compulsory. Other than that, they have a choice. They're not bound to have the external audit. They have a choice whether they should go for it or not. But regarding the listed entities and the private limited companies, which meets the criteria, and it is different in every law, every country is having their own law regarding that. They set a figure that if the private entities reach this figure, their audit is compulsory. And regarding the public interest entities, the audit is compulsory. That is the statutory audit, compulsory audit, mandatory audit, or it is known as audit by law. So an external audit, remember, external audit means statutory audit, which is being performed by an independent firm, the external auditor. So statutory audit, mandatory audit, annual audit is a type of assurance engagement. Now, assurance simply means the confidence, an activity in which assurance is provided So assurance engagement means the activity in which assurance is provided. An external audit is a type of assurance engagement that is carried out by an auditor to give independent opinion. Now, the opinion of the auditor should not be biased. It should be free from any intimidation. It should be free from the director's judgment. The audit opinion should not be influenced by anyone. It should not be affected by someone on a set of the financial statement. Now, set of financial statements means obviously the statement of profit and loss, the statement of financial position, the statement of cash flow, statement of changes in equity, and the disclosures as well. So giving assurance simply means offering an opinion about specific information so the users of that information are able to make confident decisions knowing that the risk of the information being incorrect is reduced. Now, you have studied this thing that the meaning of the material is that material is anything which can affect the decision of the user of the financial statements. Users of the financial statements are the shareholders who have taken their decision based on the financial statements, who will be taking their decisions based on the financial statement. Let's assume I am the shareholder of ABC company. I already have the shares. And the directors have produced the financial statement. It shows a very good figure in terms of the profitability. And even the auditor has confirmed it that, okay, the financial statements are true and fair. You can rely on these figures. Now, if I'm having the money, I will be buying more shares of that company because it is growing day by day. It will be beneficial for me. But what if later on it turns out to be a disaster? Like it turns out to be a disaster. That means later on, after, for example, a month or two, it discovered that the financial statements were manipulated. The auditor gave the incorrect opinion. The auditor was having a tie with the directors. They took a bribe to give the clean chit, and then now the share price is down, and I lost all the money. So the thing is, that is why I need, being a shareholder, a person who is independent, who should not have any sort of ties, any sort of relationship with the directors. An external firm who is a reputed firm, who is a member of the supervisory body, a professional body, who have experience in doing the audit, who have qualified accountants, qualified auditors. And when this is the case, obviously, I will be relying on the auditor's opinion, and based on that, I will be making confident decisions to buy more shares, etc., etc. So this is something very important to understand, that the audit and assurance, audit means the activity and assurance is the product of it. The background of the audit is the agency theory. It's the relationship between the principal and the agent. And audit started because of the agency problem. The directors may manipulate the financial statement. They may try to show, a bad, a good picture. In fact, it's a bad picture. Like, for example, another example you can try to understand is, let's assume I am the director of a company, and from your law paper that the directors are appointed for a 3 years term. It's my last year, and I didn't perform very well in last 3 years, and it was a worsening position from my side. Now I have a fear that because of my performance, I will not be recruited further. My contract will not be renewed, and then I will be dismissed by the shareholders. And then suddenly I thought, why not to manipulate the financial statements so that it shows, a different picture to the shareholders? Why not to window dress it so that it shows, some sugar coated stuff to them, just to retain my position as a director in the company? So there are many reasons why the directors may be manipulating the financial statement. That is why there is a concept of the audit. So auditor is an independent person who will be checking the financial statements, and as a result, they will be giving the confidence to the shareholders that whether or not the financial statements are true and fair.